Hey there. Let's dive into the latest buzz from the financial world, shall we? Welcome to Whiteboard Invest, your #1 go-to source for clear and concise investing knowledge explanation and news updating daily. Let's chat about Bitcoin and the market mood, shall we? So, there's been a lot of chatter lately because Bitcoin took a little tumble below $63,400, and it seems like everyone's suddenly in a panic, telling folks to sell off their BTC. But here's the thing. This isn't the first time we've seen this kind of fear, uncertainty, and doubt, FUD, in the market. In fact, last time there was this much worry in the air, Bitcoin bounced back up to $67,869. Pretty neat, right? Now, for the nitty-gritty, there's this cool tool called the MVRV Z-score, which helps us spot when the market might be hitting a high or a low. Right now, Bitcoin's MVRV Z-score is sitting at 2.32. Historically, whenever it's dipped below 2.60, Bitcoin's price has rallied back, so that's a hint that we might see a recovery soon. And then there's the Pi Cycle Top Indicator. Sounds fancy, huh? It's another way to check if Bitcoin is getting too hot to handle. Currently, the 111-day Simple Moving Average, SMA, is still chillin' below the 350-day MA, which suggests that Bitcoin isn't at its peak yet. So, what does that mean for us? Well, it could be gearing up to make a run for $80,000 to $85,000. So, despite all the doom and gloom talk, these metrics are like a secret code, telling us that Bitcoin might just be getting ready for another exciting climb. Keep an eye on those numbers. Up next, we're having some bad news right here. Let's dive into Senator Elizabeth Warren's take on cryptocurrencies. She's sounding the alarm, saying that cryptos are becoming the go-to for some pretty shady stuff, like child abuse activities. It's the anonymity of digital currencies that's got her worried. It makes it way too easy for bad actors to trade illegal content without getting caught. Warren isn't just talking the talk. She's walking the walk, too. Back in December 2022, she introduced this bill called the Digital Asset Anti-Money Laundering Act. The goal? To get crypto companies under the same legal umbrella as traditional financial institutions, making it tougher for illegal activities to fly under the radar. Now, for a bit of real-world context, the Financial Crimes Enforcement Network, FinCEN, flagged over 1,800 Bitcoin addresses that they suspect are linked to child exploitation and human trafficking. That's not all. Remember the shutdown of the Welcome to Video site? Or that dark web case in the Netherlands? Both involved child exploitation, and both had cryptocurrency in the mix. So, the gist of it is, while cryptocurrencies have their perks, they also come with some serious risks, especially when it comes to illegal activities. Warren's pushing for tighter controls to make sure that the digital world doesn't become a playground for criminals. And those examples? They're the wake-up call showing us why this is so darn important. So, the FBI's latest report is like a thriller movie plot. It's got a whopping $12.5 billion lost to crypto scams in 2023 alone. That's a 22% jump from the year before, and it's got everyone's attention. Now here's the twist. The U.S. is playing catch-up with regulations. We've got the SEC, CFTC, and IRS each doing their own thing, which is kind of like having too many cooks in the kitchen. This mishmash of oversight is leaving some pretty big loopholes for hackers to slip through. But wait, there's a plan? The smart move is to go on the offense with some solid defense. Think strict anti-money laundering laws and tight reporting standards for crypto businesses. This isn't just about slapping on a Band-Aid. It's about building a fortress to keep investors safe. And it's not just a local issue. It's a global heist scene. Take the North Korean hacker groups, for instance. They've been on a digital looting spree, bagging around $3 billion since 2017. Plus, there's a new breed of Ponzi schemies popping up on social media targeting folks who are just trying to get a piece of the crypto pie. So, while crypto has made life a breezy for many, it's also opened the floodgates for criminals. It's like the Wild West out there, and it's high time for the sheriffs to step in and restore some law and order in the digital frontier. And those examples? They're the wanted posters showing us who we're up against. Let's talk about CONSENSYS and their bold move against the SEC. So, CONSENSYS is like, back off, SEC. They've gone to court to say that Ethereum should not be called a security. Why? Because they believe that's just putting a damper on all the cool stuff developers could create. Now, Ethereum's been switching things up with its proof-of-stake, POS system, which is all about spreading the power around and making things more decentralized. That's a big deal because it's the exact opposite of what the SEC is worried about. Too much control in too few hands. If CONSENSYS wins this legal tussle, it could be a game changer. It might just tell the SEC to stay in their lane, which is dealing with actual securities, not software like Ethereum. And here's a kicker. Ethereum's got over 1.44 million validators, keeping things in check after its big update, the merge. That's a lot of eyes making sure everything's on the up and up. Plus, there's this guy William Hinman, a former SEC director, who once said Ethereum isn't a security. So CONSENSYS is standing on some pretty solid ground here. In a nutshell, CONSENSYS is fighting for a world where regulations don't kill innovation, but support it. They're saying, let's make rules that help tech grow, not hold it back. And those examples, they're the proof in the pudding that Ethereum's doing things right and deserves the freedom to keep on innovating. Cool, right? So, Phoenix Wallet and Wasabi Wallet are packing their bags and waving goodbye to the US market. Why? Well, Uncle Sam's been tightening the reins on self-custodial cryptocurrency wallet providers, and these two just don't want to deal with the hassle. Here's the scoop. Async and ZK Snacks, the brains behind Phoenix and Wasabi, are worried they'll be tagged as money services businesses. That's a big deal because it comes with a whole bunch of legal strings attached. And it's not just them feeling the heat. CONSENSYS and Samurai Wallet have already had a taste of the legal sizzle with the US authorities coming after them. This has got a lot of folks questioning if self-custodial wallets can even stay afloat with all these legal challenges. But hey, it's not all doom and gloom everywhere. Over in Europe, regulators seem to be chilling out a bit and easing up on proposed regulations for self-custody wallets. To paint a picture for you, think about the Wells notice that CONSENSYS got slapped with by the SEC, or the Samurai Wallet co-founders getting cuffed. These are the kind of headline-grabbing examples that show just how intense the regulatory scrutiny is getting in the US. About Franklin Templeton's latest crypto move. They've tossed their hat into the ring with an application for a spot Ethereum ETF, and it's got a snazzy name, Franklin Ethereum TR Ethereum ETF, EZ. Now, this isn't just any old application. It's made its way onto the DTCC's list, which is kind of like saying, get ready, we might be coming to the market soon. But here's the kicker. Just because it's listed doesn't mean it's a done deal. The SEC still has to give it the thumbs up, and that's no small feat. The big day for the decision is May 23, 2024. So mark your calendars. And Franklin Templeton isn't the only player in the game. Giants like BlackRock, Grayscale, VanEck, and ARK Invest are all vying for their own spot Ethereum ETFs. But word on the street is that the SEC might be tougher on these than they were on the Bitcoin ETFs. So, what's the buzz among the experts? Well, they're giving it a 35% chance of getting the green light from the SEC. Not exactly a sure bet, but hey, in the world of crypto, that's pretty exciting odds. Let's wait and see if Franklin Templeton can score a win and make crypto history. Break down what's happening over at the DTCC. They've decided to play it super safe with crypto and are not messing around. So they're giving a big fat zero value to any investments backed by crypto assets when it comes to using them as collateral. That's right, a 100% haircut, which in finance speak means they're treating these assets like they're worth nada for collateral purposes. But wait, there's more. They're also getting strict with corporate notes and bonds that are rated B1 to B3, bumping up haircuts to 70%. This is all part of a bigger plan to tighten up risk management. What does this mean for folks in the finance world? Well, if you're using crypto exchange-traded products to back up your position, the DTCC's new policy is basically saying, nope, we're not counting those anymore. And this has got people talking. There's a lot of speculation about how this might affect Bitcoin ETFs. Like, will there be less money flowing in? Will it change how risky investors think these ETFs are? The big banks and financial institutions are definitely feeling the impact of this decision. And while the article throws in some expert opinions and a reminder to double-check the facts, the message is clear. The DTCC is putting on the brakes when it comes to crypto as collateral. So, let's keep our eyes peeled and see how this plays out in the market. About what's been going on with Telegram. So, in less than a day, the app went kaput, not once, but twice. Talk about a bad tech day, right? Users couldn't send messages or make calls, which was a real bummer. The crypto crowd? They weren't thrilled, to say the least. A bunch of them started looking for greener pastures over at Platform X, making it clear they weren't happy campers. And it wasn't just individuals getting twitchy. Some crypto channels that were all set to make Telegram their home base are now eyeing Discord instead. Can't blame them. You need a reliable place to chat about all things crypto. But hey, it wasn't all doom and gloom. Some folks got creative and whipped up memes to lighten the mood. Gotta love that spirit, right? Comparing this to past global social media blackouts, it's clear these platforms are super important for business and communication. Even though Telegram got back on its feet after about half an hour, they've been pretty hush-hush about what went wrong. This has left users and investors a tad nervous, especially since social media is such a big deal in the business world these days. So, fingers crossed that it's smooth sailing from here on out for Telegram. So, Yuga Labs, the folks behind Bored Ape Yacht Club, are shaking things up again. Despite the market looking a bit brighter, they're still feeling the chill from the bear market days. The co-founder, Greg Solano, is all about trimming down the team to get back to their creative roots. They're not just cutting back for the sake of it, though. They're aiming to become this lean, mean, crypto-native team that's all in on Web3 games, like their Other Side Metaverse project. Solano reckons that the company's been tangled up in too much corporate red tape, and it's been stifling their original vibe. It's tough to see folks go, but these layoffs are part of a bigger plan to streamline and focus on what they do best. Remember last October, they had to let some people go then too. And now, they're spinning out projects like HVMTL and Legends of the Mara to keep things tight and on track. So, that's the lowdown. Yuga Labs is on a mission to stay true to their vision, even if it means making some hard choices along the way. And these moves? They're the proof that they're serious about sticking to their game plan. About Justin Bieber's foray into the NFT world. So, the pop star jumped on the NFT bandwagon with a splash, dropping a cool $2 million on some digital art pieces. But, oh boy, the tide turned fast. His NFT stash, which included some flashy Bored Apes and mutant apes, took a nosedive in value, plummeting by a staggering 94.7%. Now it's hovering around just $100,000. The NFT market's been like a roller coaster, and even the so-called blue-chip assets that Bieber bet on weren't immune to the wild ride. Despite the downturn, he's still holding on to one Bored Ape and one mutant ape NFT valued at about $47,000. Plus, he's got nearly $500,000 in ETH and ape tucked away. So, what's the takeaway? Well, Bieber's NFT saga is a cautionary tale of the market's volatility. It's a reminder that even the hottest trends can cool off, leaving even celeb investors like Bieber feeling the chill. But hey, that's the game of high-stakes digital collectibles for you.
Alright, that's hottest news today. If you guys did find this video helpful, leave a like and subscribe our channel for more free content. Thanks for watching. Peace out.